So let's go ahead and start filling out the balance sheet. We'll start up at the top with the name of the company, Shoeshone Company. That goes on the first line. On the next line, it's already filled in for you if you're using the paper with your handouts. And then the date would go on the third line. Remember, the balance sheet is for a period of time, so it's going to be June 30, 2011, as our problem tells us. That's when they're, that's the period that we're reporting their assets, liabilities, and owner's equity. All right, starting with current assets. Now, I kind of told you what a current asset was, but there's actually an order for these current assets. You're always going to be listing the most liquid current asset first. And there's nothing more liquid, meaning easily converted into cash, than cash. Okay, it's $28,800. Okay, what other types of things do we have listed as assets? Well, I saw accounts receivable and supplies, and we had prepaid insurance and prepaid rent. And of those things, accounts receivable is probably something that we're expecting the money. If we're trying to pay a bill and we don't have enough money in the bank, we're thinking, when is that money going to come in that our customers owe us? So that is listed next. And I think for the Shoeshone Company, that was what, $18,725. All right, looking between supplies and prepaid insurance and prepaid rent, which one of those is considered the most liquid? Well, I can tell you the insurances and the rent, we're probably not going to cancel out on them. I mean, it might happen that we do, but supplies would be the most liquid. We could return those probably and get our money back if we needed to. Probably not going to cancel out on our insurance unless we don't have the asset anymore. So prepaid insurance, both of those prepaid accounts that we classified as assets, I don't know that it really would matter which order we had it in. All right, and then after you've listed all your current assets, make sure you have them all. And what I do when I'm working one of these sheets is I mark through everything that I've listed to make sure there's not something else there. When we're through listing our current assets, we add them up, and this should be $53,700. All right, the next section is fixed assets. Fixed assets, again, this is something that we're going to hold on for a longer period of time. All fixed assets are depreciable except for land. Okay, the only one that I think I saw for this company was equipment. So we're going to put equipment here. And that was $90,600. All right, under our fixed asset, if we have any accumulated depreciation, that's where it would be listed. They'd be grouped together. And here we do have some, so we're going to say less, meaning it's subtracted, accumulated depreciation. All right, our accumulated depreciation, I believe, is $21,100. And I think that's the only other asset that we haven't listed. So we should be through with our assets. Now we want to get our total fixed assets. The number one mistake I've seen people make with this is they add depreciation. I wish we could. The depreciation actually has to be subtracted. So we get our total fixed assets. When we have depreciation, we have to accumulate depreciation. You have to make sure you subtract it. $69,500. And then we'll add our current assets and our fixed assets to get $123,200. Okay, going on down, current liabilities. Okay, I think they're Current liabilities are going to be anything that is due in the next year. So here it looks like we had salaries payable. And I mentioned earlier that I don't think there's any employee that would wait over a year for their wages and still work there. So that's definitely current. Accounts payable, anything that's due in 30 days or less. So let me go ahead and write those up there. Accounts payable. And salaries payable. And there was one more we classified as a liability, and it was unearned fees. Unearned fees really most always is going to be current because usually you're not taking deposits for over a year in advance. So if that's the case, unearned fees would be a current liability. Again, this is money we collected in advance before we received it. Okay, now we're going to total our current liabilities. If we add them together, $11,700. All right, now there's a space for long-term liabilities. Did we find any long-term liabilities for the Shushan Company? I don't see any long-term liabilities. Actually, the truth of the matter is, the business doesn't have to have any liabilities at all. They have to have assets and stockholders' equity, but they don't have to have liabilities. If they don't own any long-term liabilities, we can just leave that section blank and come down to the stockholders' equity section. Okay? In that section, capital stock is always going to be first. For $50,000. All right, and then we also have retained earnings. In this case, it was given to us. We didn't have to bring it over from a retained earnings statement, so this problem is guaranteed to balance. It gave us all the numbers we needed in the problem. All right, then we're going to add these two down to get total stockholders' equity of $111,500. And now to get our total liabilities and stockholders' equity, we'll take our current liabilities from here. I guess I should have also brought the total down because our current liabilities were actually our total liabilities. So we're going to add total liabilities plus our total for stockholders' equity, and that should give us $123,200. And that's all for this session.